Welcome to Turning Hard Times to Good Times. I'm your host, Steve Taylor. I'm speaking to you from New York City, the birth of Queens. It is May 24th, 2022. Before we talk more about today's show, I'd like to remind you that I am the editor of a newsletter called J. Taylor's Gold, Energy, and Tech Stocks. You can subscribe to that letter by going to miningstocks.com. Miningstocks.com, or you can call our office here in New York City during normal work hours, 718-457-1426. Also like to encourage you to consider signing up for Chen Lin's letter, What is Chen Buying, What is Chen Selling? That's at chenpicks.com. Chen has real strength in the biotech sector, which he's done extremely well with, and has some exciting stories there now that he's passing along to his subscribers. And we like to also remind you that Michael Oliver can be subscribed to his excellent newsletter, Momentum and Structural Analysis, by going to olivermsa.com, olivermsa.com. Michael will be with me in just a few moments to give us his take on these tumultuous markets, and you're not going to want to miss what Michael has to say, I'm sure. We want to thank all of you for listening and making it one of the more popular shows in the Voice America Business Channel. Also like to encourage you to send along whatever comments you have about this show to questionsfortaylor@gmail.com, questions, the number 4, taylor@gmail.com. We also want to thank our sponsors for making this show economically viable. Today's sponsors are Irving Resources, Novo Resources, El Oro Resources, Core Assets Corp., Timberline Resources, Lion One Metals, SK Mining, and Reyna Gold Corp., a new sponsor to the show, and we'll be speaking to the CEO of that company in a few minutes from now. I've titled today's show, How Serious is the Fed About Tightening Credit? Or you might ask the question in a different way, How serious is the Fed about fighting inflation? Peter Boockvar, Michael Oliver, returned as guest, and then, as I noted, Michael Wood, the CEO of Reyna Gold, will visit for the first time. Peter Boockvar recently stated on CNBC that the Fed is embarking on the most aggressive tightening program in 40 years. He also recently noted that sell-side analysts have not yet begun to lower earnings estimates for this year, and that will most certainly result from tighter monetary conditions and resulting operating costs increases that are rising from supply chain disruptions and inflationary pressures in general. Well, for me personally, I'm guessing that analysts will very soon start altering their earnings projections downward for these companies, especially given what we just seen this past week, last week, in fact, with the retail sector. Some blood in the streets there in that sector, that's for sure. I will ask Peter for his overview of the markets, where he thinks we are headed, and how he and his team at advisors at Blakely Capital are coping with these tumultuous markets. And in the second segment, that's when we'll talk to Michael Wood, the CEO of Reyna Gold, a new sponsor of this show. This is a company that has some very exciting exploration projects, one in particular in northwestern Mexico, gold project, and we'll learn more from Michael Wood when he comes on in the second segment of today's show. But right now, I'm happy to tell you that Michael Oliver is with me, and boy, is it good to have Michael with us at times like these. Well, Michael, thanks for joining me again.
Good to be here.
It's good to have you here. I know you're safe and secure up there in the Rocky Mountains somewhere, nestled away in your hidey place, but we're down here in New York City, so we're wondering what you're thinking up there in the safety of your place where you live up there.
Well,
then some people are.
Yeah.
You're hiding. So some people
I'm hiding in Gulch. Okay.
Good for you. Well, some people are comparing the present stagflation to that of the 1970s when Paul Volcker put an end to an inflationary problem that seemed to be spiraling out of control. And that paved the way for a couple of decades of booming stock and bond prices. And recently, though, Jerome Powell seems to think that he's the second coming of Paul Volcker. He believes that he's going to be able to do the same thing that Mr. Volcker did, that is to tame inflation, put it back in a box, get it below that magic 2% level, which for some reason is sacrosanct to these guys. But in a note to me this morning, you suggested that Powell doesn't understand that his problem is much different than what Volcker faced, and probably much more of a challenge than what Volcker faced. Talk to us about that.
Sure. First off, before we start, when I use the word inflation, when I do, I don't reference that it's commodity related. Okay, everybody seems to think inflation's only when commodities go up.
Right, right.
Price of stuff in a grocery store, gasoline, all that. We've had inflation for decades. It goes and goes and goes. The money supply increases basically double every decade. since 1959. Since over the last 2 years, it's gone up parabolically. Okay, Powell used the excuse of the virus and so forth. And he bought assets as well. So monetary inflation is the issue. It's not the issue of where did it go. Because sometimes the flow of that river flow is diverted by asset managers and investors into different places. For instance, in the late 70s, they diverted it into commodities and gold, not to stocks. Stocks were a wasteland from 1975 through 1982. You didn't make any money in the stock market. It went up and down, didn't go anywhere. It was a commodity boom, basically that began in mid-76. Gold made a secondary low there at 103 and went up to 850 by January of 1980, so 3.5 years. Commodities also went up. They tripled. Gold went up eightfold. Okay. Volcker came in, and he's regarded as the guy who brought down inflation. Okay. Well, if you consider it to be commodities.
Yes.
First off, back then, you'd already had an eightfold move. Volcker was put into office in late 1979. Gold peaked 3 months later. Okay. The Fed funds rate back in the mid-1970s, when gold was making its secondary low at 103 after having been at 200 in 1975, it pulled back in 76 to 103, which got cut in half, and then it started its 3.5-year bull market. All during that time, the Fed funds rate went from like 4% up to, by the time Volcker came in, about 12%. He jerked it up in the last months of 1979 to 15%. And finally, in March of 1980, gold had already peaked in January and dropped a couple $100. He raised it to 20%. But if you look at a gold chart then and look at a Fed funds chart, gold didn't care that the Fed was constantly, dramatically raising rates. It still went up eightfold.
Right.
Okay. Finally, it peaked. Well, why not? It went up eightfold in 3.5 years. So as a technician, it was no surprise to us to see gold peak, and also about 6 months later to see the commodity complex peak, the CRB index, in late 1980. Volcker takes credit for that, but in fact, the interest rate rise had been ongoing all during the late 70s. A sharp rise.
Right, that's true.
He simply added a few more sharp points. They were ready to top anyway. Okay, now back then, it's true that inflation, quote, unquote, was commodity related. CRB had tripled in value, okay? Gold had gone up eightfold. This time around, it's a totally different bubble that's about to break. It's, in fact, in the process of breaking. It's a stock market bubble. The S&P has gone up eightfold since 2009, and the NASDAQ 100 has gone up about 16-fold over a 12-year period. So there's your asset bubble now. It's not the commodity complex. In fact, if you look at a Bloomberg chart and compare it to the price levels it had back in 2008 and 2011, we're not even near those highs. Yes, it's been a dramatic move up out of the hole on a percentage basis, but in terms of old historic highs in the commodity complex, we're not even near it, and we've only been going up for a year and a half. It's not very old, and it's certainly not overbought. Gold, meanwhile, has only doubled since late 2015. It's not gone up eightfold, and over the last year and 3 quarters, it's gone sideways. So, there's no bubble there. So when he goes in to prick the bubble, he's pricking it. For example, let's say you're a portfolio manager or you're a financial planner and you give people advice. Your normal components of a portfolio would be, well, stock market, municipal bonds, high-yield corporate debt, U.S. Treasuries, real estate. Okay? How are they doing this year, just the first 5 months? S&P's down about 8%. NASDAQ is down NASDAQ's down to 28%. S&P's down about 18%. Muni bonds are down 9%. High-yield corporate debt down 13%. U.S. Treasuries, using the TLT ETF as our benchmark, down 20%. And real estate ETFs down about 17%. So every single component of a normal orthodox portfolio is being smashed. This is a crisis because the alternatives haven't worked. The T-bonds have not worked. They're getting a rally right now, but they're still down 20% on the year. So if you're looking at your portfolio, you're in bad shape. What's up on the year? And nobody seems to be talking about it. Gold's up 2% on the year. Well, who cares? Well, it's up. It's about the only core portfolio asset component that is, it's always been considered, marginal, but always sort of in the portfolio as a possibility. It's up 2%.
Yeah.
Nobody's noting it. Well, I think it's going to get noticed more and more as time goes by. Anyway, so the bubble is breaking is the stock market and these other linked assets. What is the central bank going to do once it becomes bleeding obvious that they get out of control on the downside, and that the economic metrics that we're used to seeing, every week, the, metrics that the Fed looks at, data points, as Powell calls it, start to turn negative rapidly, and they are. They're starting to. Is the Fed going to keep raising rates? But more importantly, what are they going to do with their balance sheet? You'll notice that as they're going to raise rates a half a point, again in June and July. But their changes in the balance sheet haven't even begun yet. They're supposed to start in June, and they're very moderate. Okay, they're going to start divesting themselves of these assets that they outright purchased, like muni bonds and so forth. I'll make a bet that as the data points come across, and Powell made this point in his last conference, it was very subtle. He used the word data sensitive, meaning I could change my mind. Okay.
Yeah.
As the data points change, I bet the tapering off of their balance sheet is going to be very small, and might even come to a halt because they're going to need to start buying some of these assets again just simply to support them. Now, therefore, when you look at commodities, for example, everybody thinks it's transient. I think that's the popular term. Bloomberg looks to us like the worst it could do right now is drop about 10 points. That's a small percent, a single-digit percent correction, even if it corrected. Meanwhile, within the Bloomberg, forget the oil market. It might be somewhat exhausted for the time being, but watch natural gas, watch sugar, and watch the food commodities, especially this summer. The grains look ripe to do something very dramatic. So does sugar. These are basic foodstuffs. That's not been an issue up to this point. But if suddenly you start getting into food price inflation that gets dramatic, that's when you get sensitivity among the populace and investors and so forth, and instability perhaps in certain systems. So gold is watching this, and I think that's why gold isn't down like the S&P or the NASDAQ or all these other asset categories. It's still up on the year. And I think somebody's buying it. To get the message, I'm not going down. It's the only asset category across the globe that's basically up on the year. So keep that in mind when you assess gold. I think its potentials are quite dramatic as these events unfold.
Well, certainly, if we start having food, already people are having a really tough time with putting gas in their cars, putting food on their table. Average people, people that live one paycheck to the next are in big trouble right now. And you can just see it coming. There's going to be more checks doled out, probably more deficit spending by the federal government. How's that going to be paid for, Michael? How's that going to be paid for? I mean, as Alistair McLeod talks about, you have a choice. The Fed has a choice. The government has a choice. Either you defend the currency by allowing interest rates to go where the market will take them, or you destroy the currency. And I suppose you're suggesting the gold market is seeing a destruction of the currency. Well, certainly that's what we've been having on us, at least on a moderately paced basis, right? But what happens if this thing really gets out of control, and then it's the whoosh, as you call it?
Yeah, I think the events could be I go with chaos theory at this point. Instead of an incremental change in these market trends and the real world consequences of those changes, including political, social disorder, and all these things, I think it'll be chaos theory time where things will unfold rapidly. I'm suspecting that by this fall we're going to see all kinds of very rapid events having unfolded. And I still love the fact that when there was a Wall Street Journal section in the paper the other day about what you can do to help yourself during an inflationary time, and they had like 10 things to do. None of them mentioned buying gold.
No, they're not programmed that way.
That doesn't seem to be. No, I have not heard it pointed out that gold is the only asset up on the world, up on the year. Why not?
Yeah. No.
I'm sure some asset managers realize this. So.
Well, I think there's a vested interest in. I mean, we've been programmed not to think that way, Michael, and certainly the powers that be don't want us trading our dollars in for gold, or they'll lose their. I mean, Alan Greenspan understood that and talked about it a long, long time ago. That it's the enemy of socialism is gold. It gets in the way of the socialist programs, and all these government guys. How do they stay in office? They give things away, right? So that's
well,
where we're at. But I mean, how do we protect ourselves? And you're just saying the Wall Street Journal of all publications should be aware of that. What retains its value? What is real money? Yeah.
Yes.
So speaking of real money, Michael, the second best money there is, in my view, is silver. Silver. How's that looking to you?
No, I think it's. I have a bet with myself that silver will vastly outpace gold over the next year or two, in the remainder of this bull trend. And I think the bull trend could be historic for gold, not just another eightfold. It could be something off the page, because the other events that are occurring in other markets indicate to us that this is not a normal, fundamental, or technical time. I don't think there's been a period like this in the history of modern America, period. This is not 1929. It's far worse in terms of the fundamentals that will cause the decline. And I think there's one asset that will beat the pants off all the others. And once that realization begins to dawn on portfolio managers, even whether they don't like it emotionally or not, they're going to realize, hey, it's the only thing that's up, the only thing that's gaining. I got to be there.
Yeah, I think that's right. That's when we'll get the whoosh.
Yeah, and I think you will get a dramatic whoosh out of silver. Now we're waiting for sufficient recovery off this, what we think is a false downside breakout by silver, which took out the three lows of the last year and a half, year and three quarters, all which dipped below 22. There was September 2020, two times in 2021, silver dropped under $22 briefly. This time we went all the way down to 2040, so we swept those lows. Right now we're back above 22 again. So it looks like that breakout didn't quite take. And we're looking for some numbers overhead that will indicate, okay, it's going back up. And I suspect on a percentage basis that silver will vastly outpace gold. It will again become the poor man's gold.
That's usually the way it works. Anyway, we're going to have to leave it go at that, Michael. Thank you so much for sharing your thoughts on this, on all these important topics.